Charles Schwab Chief Investment Strategist Lizanne Sonders is with us. Lizanne, great to have you back. I wonder if you are starting to think more about what some argue are dwindling chances of a soft landing, growth concerns. I see B of A today says that if enough things go wrong in Q4, it's not that hard to argue for a negative GDP print.
So I guess I'd start by saying I think the recession versus soft landing debate, we didn't fall in really either in a traditional sense, because the whole notion of a rolling recession is that we've had pockets of the economy that have had their own recessions. Manufacturing, housing related, a lot of consumer oriented goods. So a soft landing in a traditional sense isn't really a possibility because of those aforementioned hard landings. The problem now is very obviously the rise in oil prices, which doesn't have as much ripple effects into other segments of inflation as was the case, say, in the 1970s, but it does have a quicker impact on consumption patterns, which is why I think the spike in oil prices has brought back in this notion of an actual formally declared recession. And when you look at the recent housing data with the housing market index and housing starts today, unfortunately, where there was some hope for offset with an improvement in housing, maybe rolling over yet again.
Right. How did we go from so many conversations about achieving energy independence, right, to a point where we are now looking at so much excess capacity between the Saudis and OPEC Plus, where we're essentially being held hostage to some degree?
Yeah, and clearly with decisions that are made by members of OPEC to restrict supply, that can cause an upward move. There's been a bit less production in the United States, certainly relative to what we saw back in the kind of, mid aughts, I guess we're calling it. Not to mention the fact that you've got these other constraints already on the consumer, but also some of the big sort of corporate consumers of energy like the airlines, and you're seeing that reflected in stock prices. So this is more of a supply story on oil, not a demand story, which is why it'll be really interesting to hear how Powell addresses it, given that the blunt instrument of monetary policy changes and rate hikes can only affect the demand side of things, not the supply side of things.
So what's the strategy from here, Lizanne? Do you do a traditional sort of recession-type playbook, consumer staples and utilities, or should you be looking at other strategies? Because, again, this isn't like a typical economic cycle.
It isn't. And, in fact, this cycle, for the most part, defensives have not been those classically defensive areas like staples, like healthcare. We've had a couple of bouts where during tumultuous times, particularly during the worst part of the pandemic, but then this year when we had the banking crisis, what became the defensive areas actually were up the cap spectrum into the techie kind of space. Now, in the pandemic, it made sense because those represented the ecosystem in which we were all living, and that was the only ecosystem that was sort of thriving in that environment. I think in the banking crisis, it was more about stability and strength via cap and strength of balance sheets, but you're not seeing the kind of consistent outperformance among those traditionally staple areas. And I think it goes back and reinforces what, as you know, we've been talking about for a couple of years now, which is factor-oriented investing. You can get defensiveness via factors by looking for ample interest coverage and strength of balance sheet and strong free cash flow. You can add in the growthy factors like positive earnings revisions and get at to where opportunities lie, and frankly, where there's been more consistency in terms of performance has been at that factor descriptor level, not at the sector or maybe simplistic growth versus value index level.